money feels natural, like it has always existed, but almost everything you believe about money is recent. For most of human history, there was no money, no banks, no inflation, no debt cycles. So why did we invent it, and why does it now control almost everything? Money is everywhere. We work for it, we chase it, we worry about it, but very few people stop and ask one simple question: what is money? Really? Today we're not giving advice, we're not predicting markets, we're understanding the system. Before money, people traded directly. You had wheat, I had tools. If we both wanted what the other had, trade worked. But that system only worked when wants matched perfectly. As societies grew, barter became impossible. Not because humans were greedy, because complexity demands abstraction. Money was invented to solve coordination at scale. Societies began choosing objects everyone valued: shells, salt, cattle, metals. Eventually, gold and silver dominated, not because they were magical, because they were rare, durable, divisible, and hard to fake. Money became a storage device for value across time. For the first time, effort could move through history. You could work today and preserve value for tomorrow. Civilization accelerated. When rulers standardized coins, money changed again. Coins carried faces, symbols, authority. Money became political. Taxes forced people to use state-issued currency. Money did not spread because people loved it. It spread because governments required it. This was the first major shift. Money became an instrument of power. Carrying metal was heavy and dangerous, so paper replaced weight. At first, paper promised gold. You could exchange it at any time, but eventually governments removed the gold backing. Modern money is not backed by metal, it is backed by trust. Trust in institutions, trust in governments, trust in stability. Money became belief. Here is where most people misunderstand the system. Banks do not just store money, they create it. When a bank issues a loan, new money appears, not transferred, created. A mortgage creates money, a business loan creates money. This allows economies to expand, but it also means debt grows faster than physical currency. Growth becomes dependent on borrowing. Expansion becomes systemic. Crises become cyclical. This is not an accident, it is structural. When instability rises, central banks step in. They control interest rates. They influence liquidity. They determine how expensive money becomes. Lower rates encourage borrowing. Higher rates slow expansion. Inflation is not random. It reflects monetary conditions and policy decisions. When money supply expands faster than productivity, prices rise. When credit contracts, recessions follow. Money is no longer just a medium of exchange. It is macroeconomic steering. Today, money is invisible. Cards, apps, digital transfers, numbers on screens. The easier money moves, the harder it is to feel. Spending becomes frictionless. Convenience increases. Awareness decreases. Digital money is efficient. It is fast. It is global. But efficiency always comes with trade-offs. Control increases, privacy decreases, the system becomes smoother and more centralized. Money did not make humans greedy, it made decisions measurable. It allowed societies to scale, it enabled growth, innovation, and complexity. But money is not neutral, it shapes behavior, it shapes incentives, it shapes power. Understanding money will not make you rich, but it changes how you see the world. And once you see the system, you cannot unsee it. Thank you for watching this video. If you like this video and would like to see more videos like this, please subscribe to the channel.